Hello and welcome to a video that's going to help you through the example that's on the final slide of the capital investment / capital budgeting presentation. So if you review, it tells you that you're considering starting a new delivery service for your restaurant. The cost of a new delivery car is $22,500. The new delivery service should increase revenue by $2,500 a month, which is $30,000 a year. Your typical cost of goods is 33%, and you estimate the salary of a part-time driver would be about $8,000 per year. Maintenance, insurance, and gas would be about $500 per month, so $6,000 per year. And we're assuming a tax rate of 28% and a CCA rate of 30%. So we have to prepare a 5-year relevant cash flow analysis for this POS system. Okay. And it shouldn't be POS system, it should be for this car. Okay. So we are purchasing a food delivery vehicle. Okay, and that's what we're putting together a net cash flow analysis for. So we'd probably put year 1, year 2, year 3, year 4, and we're going to do this for 5 years. Okay. Now, the first thing we always start with when we're putting together a relevant cash flow analysis is we have to start with the increase in savings or the increase in revenues that it's going to provide me, this investment I'm making, that it's going to provide me on a yearly basis. So in this case, the cost is $22,500. Should increase revenue by $2,500 a month or $30,000 a year. So we're talking about the fact that it's going to increase revenues for me. Okay. So that's what I'm evaluating, this increase in revenues. And sorry, now it's going to increase revenues by $30,000. And it's going to be the same every year. Don't mind me, I'm just going to use Excel to my advantage. So it's going to be a positive increase for $30,000. Now, the next thing that we have is we have to concentrate on any directly related costs to this investment. So in this case, the first thing that we see is the typical cost of goods sold. So because we're talking about a restaurant, we have to think that the fact that it's going to increase revenues, well, there's an increase in cost of goods as well. Food and beverage costs are going to go up. So we need to decrease the fact that 33% is going to actually just go right from those revenues, is going to go towards food and beverage, because if we're increasing our revenues, our costs are just naturally going to go up for food and beverage. So we'd have to find out what 30,000 times our cost of goods, which is 33%, is. So 9,900, and our revenues don't change from year to year for this investment, so we can just copy that over. Okay. We then need to decrease our driver's salary. Okay. So if you take a look, salary for a part-time driver would be about $8,000 per year. So that's directly related to this investment. So $8,000, and again, it's going to be every single year. So I just need to account for that every single year. Maintenance, insurance, and gas would be about $500 per month, $6,000 per year. So we can just call this other costs, and it said $6,000 a year, and we just drag that over. So this first part should be fairly simple, where we just simply take the savings, the increase in savings or the increase in revenues, minus any directly related costs of this investment. Okay. Now the next part is where we have to get rid of our capital cost allowance. Give me a second, there you go. So for this, we need to kind of do something a bit different over here. Okay, so we need to have a CCA rate of 30%. Okay. And we'll change that to rate instead of rat. Let's write down first how much the investment is initially worth. So the initial investment is $22,500. That's how much the car costs. We want to know for year 1, year 2, year 3, year 4, and year 5 what's going to happen. We need to know what the CCA deduction is every year and what the undepreciated capital cost is every year. So in year one, our depreciation expenses are $22,500 times the 30%, so 0.3, but never forget the half year rule. So we have to multiply that by 0.5, 50%. And that's going to tell me how much depreciation expense I can have in year one. So $3,375. We'll keep to rounding because we don't want to talk about cents in this case. So my undepreciated capital cost at the end of year one is going to be how much it was at the beginning, the $22,500, minus that depreciation. So that's going to give me an undepreciated capital cost at the end of year one of $19,125. This is also the beginning value in year two. So for my year two depreciation expense, it's how much it's worth at that moment in time times my depreciation expense percentage. Okay, my CCA rate. And then I would simply go how much it's worth at the beginning of the year minus the depreciation expense. And then I would continue to do it this way. So 13,387, which is my new value, my up-to-date value, times the CCA rate. And then my running value, my up-to-date value at the beginning of year three is $13,387 minus how much I depreciated. And then we go $9,371 times my 30%, pardon me, and then go $9,371 minus my depreciation expense for that year. Again, one last time, this undepreciated capital cost is for the end of year four, but it's also the value at the beginning of year five. So because it's how much it's worth at the beginning, that's what I'm multiplying by 30% to find out the depreciation expense for that year. And then how much it's worth at the beginning of the year minus how much I depreciate. Okay. So this information we definitely need. We're going to need all of these. Okay, just as a reminder. And then we're also going to need the year five undepreciated capital costs later on. So now we can simply transfer over these numbers. So in year one, $3,375, $5,738, $4,016, $2,811, $1,968. Okay? So I'm just taking the CCA rate from each year, how much I depreciate each year of this asset. Because remember, I'm accounting for the depreciation of this capital asset over its useful life. So I only account for the cost over its useful life, even though I've already purchased it with $22,500. I just expense it over its useful life. So that would be it. If we go through, that's it. We don't have any other costs that are associated with it. Always remember that you always have to take away depreciation. Okay? So that's going to give me my income before tax. Okay, my IBT, my operating profit. In this case, it's operating profit. In the other example that we did in class, it was net savings before tax. That's because we're talking about revenues right now. In the example in class, we talked about savings. So right now we're talking about net income before tax is all we're doing. So we would just go our $30,000, okay, minus the $9,900. minus the $8,000, minus the $6,000, and then minus the depreciation expense. Okay? And that would give me, we'll put a line here so that we understand we're doing that. Top border, pardon me. There you go. Okay. And then we would do this all over again. We would simply take how much more in revenues we're going to experience from having this car, take away the fact that we're going to have increase of costs of goods just because we have more revenue, so 33% of that amount. We're going to take away the fact that we have to pay a driver, take away the fact that we have other costs associated with it, and then take away the fact that we have depreciation. We're going to account for depreciation over time. Okay. And I'll just use Excel at this point. We would just do this over and over again. Okay. And that's what we would get. Now we would then have to calculate our tax. Okay, so taxes, and those are 28%. Okay. So we have to pay 28% tax on this new income because this is really the income that this is going to provide me, just this direct investment. See how it started with, it's going to increase revenues of $30,000, but when I take into account all the costs associated with having this actual new asset, it's only really providing me with that much income. That's not as much as we thought, and that's why one of the reasons why we do this. So now we have to account for the taxes. So $2,225 times my 28%. Okay. And you would simply just go through each one. And I'll just do it with Excel at this point. Okay. But you would go through every single income before tax and multiply it by that tax rate of 28%. That would give us our net income after tax. Okay. So in order to do that, I'm just simply my income before tax minus my taxes. So 2,725 minus my $763. And I would continue to go down this line where I go my income before tax minus my taxes, and I would continue along. And just subtracting my income before tax minus my taxes. We're not done yet because this is the one that usually catches people. We have to add back our capital cost allowance. Capital cost allowance allows us to expense the value of a new asset over its life. But really, that cash is never exchanging from year to year. We're never actually losing that cash. What it does is it brings down our taxes, how much we owe in taxes from year to year. So we're going to add that back because it's cash that we actually will have. So we're just going to simply add back all of these amounts. So 3,375, 5,738, 11, 1,968. And we're just going to add that back, and that is what's going to give us our relevant cash flow. So 9,000, it would just add them. So 261 plus $5,738. And you would just continue to add all of these together. Okay. And now this would be the information that I want to know. This investment, while it's going to create $30,000 in new revenue if I buy this food delivery vehicle, this is actually the cash flow it's going to provide me with. It's actually what I'm going to have. Not $30,000. Once we account for all the costs, subtract the CCA to find out our income before tax. We then took away the tax and then added back the CCA once we've got our tax break because for the CCA. We added back, and now we have cash flow, our relevant cash flow for all 5 years. But these are all in future dollars, so we're going to have to do something else in a second. So the next thing that we want to do is we want to evaluate the payback period for each option. And the payback period is really, we're not really evaluating for each option, we just want to evaluate the payback period. Okay? So what is the payback period? Well, I want to see this delivery car, how long it's going to take. So we can write in year 1, year 2, year 3, year 4, year 5. Okay. So this is how long, these are the different years. Now at the beginning, this is worth $22,500. That's my investment, right? So over its life, there's two approaches to do this. We just want to find out, using this relevant cash flow, how long it will take me to get to $22,500, because that's my initial investment, if you remember right here. So really what I'm doing is I'm discovering how long will it take for me to make this money back. Because if I make an investment, I want to know how long it's going to take for me to make my money back. And there's two approaches to this. Okay, we can write 5,337. We can write all of our amounts. Okay. And we can simply just keep a running total. Okay, so we can just say that this is my running total column right here. And I can just go, okay, after 1 year, I've only made $5,337. Okay. And then the next year, when I combine the two, $5,337 plus my $5,999, this is my new running total. Okay. And then if I then go my running total, my $11,336, that's after 2 years how much I've made, plus how much I'm supposed to make in relevant cash flow from this investment in year 3. We'll just do this. I've now made $16,852. I'm not quite at $22,500 yet, am I? So I need to keep on going. I'm not done. So $16,852 plus $5,179. I'm almost there. Okay. I'm at $22,031. So I've almost made my money back. So what's left? Because I'm right there. So we need to know how much money is left between my initial investment, how much it initially cost me, and how much cash flow I've made back in year 4. So that we would just go 22,500 minus how much we're at year 4. I only need to make $469 more dollars. Okay? So I can then discover that 469 is what I have left to make in year 5. Okay? So I would divide $469 by how much relevant cash flow I'm supposed to experience for year 5, and that'll give me a decimal that would probably just go down to 2 decimals. Okay? So after 1 year, I haven't made my money back. After 2 years, I haven't made my money back. After 3 years, I haven't made my money back. After 4 years, I still haven't made my $22,500, but I'm going to make it at some point in year 5. So it's taking me 4 years for sure, but it's also going to take me 0.09 of year 5. 0.09. Okay, so we're going to add these two together. So really, it's taking me 4.09 years to pay back the investment. Okay. That's one way. The other approach would be to simply continue to subtract. So we could have this as the fact that 22,500 is my initial investment minus how much I made in year 1. Okay, how much relevant cash flow I'm supposed to make in year 1. $17,163 is how much I have left to pay back. Okay. Then $17,163. The total up at this point, how much I have left to pay off of my investment or return to my investment, minus the $5,999. Well, I'm still not there yet. My goal is to get to 0 here. $11,164, which is how much of my investment I've yet to recoup, to make back, minus how much relevant cash flow I have for year 3. Still not there. I still need to get to 0. So $5,648, which is how much of my investment I've left to recoup after year 3, minus how much I have to make, how much relevant cash flow I think I'm going to make in year 4. So it leaves me with $469. We're at the same place as we were with the other approach. So we would just divide the 469 by year 5 relevant cash flows, and it would give us 4.09 years again. Okay. So if it takes me 4.09 years, if I'm an investor and I tell you that I want to make my money back in 4 years, you're going to tell me it's going to take you 4.09 years. I may say no. But if I tell you I want to make my money back within 5 years, well, this is within 5 years, so you could say yes, and I would probably go for it. Okay. Now, the last one. So we want to put together a net present value analysis. So, pardon me. I would need to know my years. So 1, 2, 3, 4, 5. Okay. And I need to know, I have the future value of all of these amounts, but I want to know the present value of all these amounts. So the future value is really just my relevant cash flows, because that's in future dollars. But remember, you're going to have less purchasing power later on. So things are going to be more expensive. So our present value is actually going to be lower than this. So we have to look at our future value and simply bring over all of our amounts. So we're just bringing over all of our amounts. 4,000, there you go. Now for the present value, if you remember, we'll just use discount factors because it's easier. I'm telling you that there's a 10% weighted average cost of capital. That's really our discount rate that we're using in order to bring this into today's dollars. Okay? So I'm going to go my future value multiplied by the discount factor is what we're doing. The discount is 10%, but we're looking only at year one. So if we go to our discount table, I'm going to look at my discount table and go, okay, 10%. First of all, this is the column that I want to look at. And then I want to know for year one. So for year one, 0.909. So I can go my 5,337 multiplied by 0.909. And that's going to tell me that in today's dollars, 5,337 is $4,851. Now I would go back to my table again. I go, okay, 10% again, but now I'm looking 2 years from now. So 0.826. So it goes 0.826 multiplied by my 5,999. Okay. So in today's dollars, $5,999 is $999 is $4,955. And then we go back. And now 10% again, but I'm looking for year three. So 0.751. So 0.751 multiplied by my cash flows, relevant cash flows from that year. And then I do the same. Let's go find out first. My discount factor for fourth year at 10%, 0.683 multiplied by the relevant cash flows for that year. And then again, last time, 0.621. So equals 4,943 multiplied 0.621. Okay. And that's going to tell me what all of these amounts, these relevant cash flows here, are worth, but in today's dollars. Okay. Now notice how this number continues to go down. Because this is the furthest day away, my dollar value will change quite a bit over time. Okay. So I can buy a lot more today with my dollars than I can later on. So now I'm going to add up my total here. Okay. I want to find out what my total of my investment is over the cash flows of my investment over the 5 years, but in today's dollars. So I'm going to add them up. Go all of these. And that'll tell me that the present value of all of my relevant cash flows is $20,556. Okay. And now we still have to do one more thing to do our net present value analysis. To complete a net present value analysis, we have to add the present value of all of our relevant cash flows to the present value of what the asset will be worth in its fifth year. So if we go back, how much will the asset be worth at the end of year 5 is what we really want to know. Well, it's going to be worth $4,592. There's only one problem. That's in 5 years. That's not in today's dollars. Okay, this 4,592, that's in future value. Okay, because that's later on in time. That's not how much it's actually going to be worth if we're looking at today's dollars. So we need to do the same thing we did here, and we need to simply multiply our undepreciated capital cost at the end of year 5 multiplied by our factor, discounting factor with that 10% again for year 5. So we go 10%, but I want to know in year 5, 0.621. So we go 4,592 times 0.621. So it's actually only worth $2,852 in today's dollars. Okay. And now that combined is going to give me the present value of that investment, over the cash flows of the overall value of that investment in today's dollars. If I add these two together, 20,556 plus 2,852. That's going to tell me that currently this is the value of this investment. Okay, that's when I take into account all the cash flows I'm going to experience, and when I take into account what the value of it will be at the end of year 5. Okay, because if I only go by relevant cash flows in today's dollars, I'm only going to make $20,556 in today's dollars, and the investment is $22,500. I haven't made my money back in 5 years. That's not good. I'm not happy with that. But we always have to remember that this asset's still going to have some value. If I were to sell it, it's going to have a dollar value attached to it. So that's why I add them both together. Now, in order to complete the net present value, I'm going to subtract my investment from my present value, because I want to see if I am actually going to make money off of this investment. That's really what we're evaluating. That's going to give us the net present value after we account for this investment. So I'm just simply going to go my $23,408 minus my initial investment that I'm thinking of making, and it leaves me with $908. Now, the rule of thumb is you should always go for an investment if it has a positive net present value. It will add value to your company. So this is a positive number, therefore we should actually move forward with it. Okay? Go back, try this out again. The solution file is online. If numbers are off by $1 or $2 or up to $5, it may be simply that an Excel formula was used, or Excel was used in, or cell referencing was used in the solution file. Use either this video or that. It's going to be the same approach. It's just a different way of getting to the same answer. Take your time with this video. Try it out again on your own. Feel free to ask any questions, but definitely practice this as you move forward to get to your final exam.